Good afternoon, everybody, and pleased to see you here. Our second day of the Precious Metal Summit in Beaver Creek 2021 is going to conclude with a very interesting talk by our good friend Ronald Stöferle of Incrementum, an independent investment and asset management company in Liechtenstein. Ronnie is managing partner of Incrementum and responsible for research and portfolio management. Also, he's author of the annual In Gold We Trust report since 2007. It's very heavy, but this is his publication. So congrats on the success of your book year after year. Over the years, the In Gold We Trust report has proceeded to become one of the benchmark publications on gold, money, and inflation. Ronnie's a member of the board of directors at Tudor Gold Corp, a significant explorer in British Columbia's Golden Triangle. And it's a great pleasure to welcome him back. This is his second time coming to speak in Beaver Creek. It's been 5 years since you last appeared here. And in the meantime, we've enlightened audiences in Zurich and London several times with your presence. Thanks very much.
Thank you very much, Jessica. Ladies and gentlemen, today I will make the case that we are at a monetary tipping point, a tipping point of inflation. I will discuss how we reach this tipping point, why inflation is not transitory, and how investors can protect themselves in this new regime. But before I start, I want to sincerely thank Jessica and the whole team. I know that putting together a conference is quite a lot of work, but especially in these demanding and turbulent and crazy times, it's definitely even more work. So I'm really happy that we can all enjoy real conferences again. I think we're all a bit fed up with Zoom meetings. So thank you very much, Jessica, for putting that together. It is actually my first big conference where I'm speaking in person for almost 2 years. And I remember in 2016, I spoke together with John Hathaway and Martin Murnbild, and somebody approached me afterwards and said, well, you sound like the Arnold Schwarzenegger of economics. And I said, thank you, so I'll be back. And coming back actually wasn't so easy because I had to get a national interest exemption to come to the US. So I had to testify to the US Embassy that it will stimulate US growth, that Ronnie is coming over here to the US. So I'm not 100% sure if US GDP will go through the roof, but I hope that I can at least broaden your vision, that I can give you some good and interesting thoughts, and that we'll all have some fun together. I also want to briefly thank our premium partners. As Jessica said, we are publishing this In Gold We Trust report for 15 years now. It is a huge project. We've got 20 people working on this report. We publish it in German, in English, and in Mandarin. We had roughly 2 million readers for the last edition. And it is really dear to our heart to inform and educate people about gold, about sound money, how to hedge against those things happening in markets at the moment, and it wouldn't be possible without the support of our premium partners to publish such a report totally free of charge. So thank you very much. Let me first turn to the theme of my talk, tipping points. Oxford language defines a tipping point as the point at which a series of small changes or incidents becomes significant enough to cause a larger, more important change. The sociologist Malcolm Gladwell helped to bring the term tipping point into popular usage when he published a book, The Tipping Point, a book that I highly recommend, in the year 2000. The tipping point is that magic moment when an idea, a trend, or a social behavior crosses a threshold, tips, and spreads like wildfire. Just as a single sick person or a bat can start an epidemic of the flu, so too can a small but precisely targeted push cause a new fashion trend. But tipping points are actually by no means confined to sociology. They can be observed in diverse areas ranging from physics to finance to history. The video behind me gives us an example, a dramatic example from simple physics. An example of a tipping point leading to a precarious situation, descending into chaos. And it is crucial to understand the tipping point demonstrated in this video was only made possible by the inherent instability of the warehouse layout. We can also see examples of tipping points in the realm of finance. Bank runs are a classic example. They result from a sudden loss of confidence, a sudden loss of trust, typically after risks have built up over a much longer period of time. We're all familiar with the collapse of Lehman Brothers. You might also remember the collapse of the British high street bank Northern Rock in 2007, September 2007, and its subsequent 37 billion pounds, peanuts, I would say, in today's money, nationalization. Both banks trace back to the 1850s, so they were around for more than 150 years. But just a few days, a few moments were enough to send these banks into insolvency. Maybe the best tipping point example comes from 20th century history. The tipping point was an event that triggered a momentous change larger than anyone involved could have ever imagined, the start of the First World War. The story is, of course, closely tied to my own country, Austria, and it was the assassination of Austrian Archduke Franz Ferdinand. It catalyzed a chain of events that went on to profoundly reshape Europe and the entire modern world. And it is important to understand, ladies and gentlemen, it was not the assassination alone that caused the war, but the precarious buildup of arms, rivalries, and tensions that came before and already developed for years, if not decades. The historian Christopher Clark wrote an excellent book about the buildup to the First World War. He called it The Sleepwalkers, because he saw that Europe had long been sleepwalking into a catastrophe. It took the tipping point of Franz Ferdinand's assassination to reveal the extent of the tensions. So the assassination was the straw that broke the camel's back, a tipping point in the true sense. I recount this lesson from history because I see it as relevant to the situation today. I believe we have been sleepwalking to a new tipping point, a tipping point of inflation. This tipping point that I will describe now will trigger changes that will be primarily economic and monetary rather than hopefully military in nature. Now, what do I mean by this? Since the 1980s, a period often referred to as the Great Moderation, Western economies have become accustomed to low inflation. You can see at the 10-year averages that actually inflation numbers went down successively. Low inflation has persisted for so long that the idea of it rising on a long-term basis seems implausible to most economists, politicians, central bankers, and investors. But from my point of view, the COVID-19 pandemic was the tipping point that will change this long-standing dynamic. As you can see on this chart, since the great financial crisis, basically the main threat that central bankers saw was that inflation numbers were too low. So they tried everything to get inflation numbers up. And now, from my point of view, they're succeeding. So COVID-19 was a true tipping point. Like Franz Ferdinand's assassination, it was the straw that broke the camel's back. From our point of view, we're now moving from an era of asset price inflation into an era of price inflation. But what are these long-term trends that I mentioned? First of all, money supply growth. As you can see on this chart, it shows the doubling periods of M2 money supply growth. We can see that broad money, M2, the measure of money supply, which is, from my point of view, most relevant to inflation, has been accelerating since the year 2000. This trend was exacerbated following the global financial crisis, and one of the actions taken by central banks in response to the GFC was to flood commercial banks with liquidity, but primarily in the form of base money to fend off a systemic collapse. M2 continued to grow solidly as a result, but it is only recently that it shows growth has started to rise significantly. In 2020, as you can see on this chart, M2 money supply increased at the fastest rate on record, with the total supply of US dollars in circulation growing by 25%. We're far above the levels seen in the stagflationary 1970s. And of course, the base effect is one cause for this dramatic change, but still we're above 15% M2 growth. So last year we saw M2 growing by 25%. You know what the performance of gold last year was? 25%. Perhaps it's a coincidence, but from my point of view, there's obviously a strong correlation between the two. So given that M2 money supply has already grown so much, why haven't we seen more dramatic inflation? First of all, because inflation is a process. Secondly, there are always time lags involved. And thirdly, due to the lockdowns that we experienced, the velocity of money has collapsed. It is worth looking briefly back at history to understand what happens when velocity falls. In both 1933 and 1946, the velocity of money was at similarly low levels. In both cases, the US government resorted to radical measures to increase it again. In 1934, the US devalued the dollar by almost 70%. In the period 1946 to 1951, it enforced financial repression in cooperation with the Federal Reserve, which kept interest rates at a very low level. So basically, it was a yield curve control. Currently, the velocity of money is at even lower levels. So from my point of view, I would not be surprised by similarly extreme countermeasures of financial repression being implemented again. My friend Russell Napier said, "But forecasting velocity is fiendishly difficult. It's like trying to juggle an incontinent squid, something you really don't want to do and you're very unlikely to succeed at." I don't know how Russell comes up with those analogies, but from my point of view, I don't want to forecast velocity. But I think that the worst of the COVID crisis is over now. I really hope that in 1 year from now, everything is going to be back to normal, whatever normal is. So from my point of view, the velocity of money will continue to stabilize and it will start rising. I now want to highlight another important trend, the rise of government credit guarantees. Governments are now going direct. Earlier this year, I interviewed my friend Russell Napier about his views on inflation and financial repression. And Russell, from my point of view, one of the best strategists out there. He has been a deflationist for decades, but now he predicts sustained inflation. And he said the crucial structural change here is that governments are providing credit guarantees to the commercial banking system. And now we have, across the world, bank credit growing really strongly in a recession, which is absolutely unheard of. He gave the example of the UK Chancellor introducing government guarantees on mortgages up to £600,000, announced in the March 2021 budget. So unlike QE or the reduction in interest rates, these schemes, these credit guarantees, offer direct incentives for banks to increase lending and thereby expand the broad money supply. And from my point of view, ladies and gentlemen, those credit guarantees are a fundamental change in the way money is created. The second long-term trend is obviously the growth of global debt. Since 2010, private debt has grown 70% to 120% of global GDP. 24 trillion was added to the total global debt mountain last year alone. The COVID-19 crisis was a real tipping point when it comes to government intervention and fiscal stimulus. The best times of the so-called frugal Swabian housewife are a thing of the past. In short, austerity is out. And debts are now so great that the sensitivity to rising interest rates is higher than ever. We published this book, The Zero Interest Rate Trap, in 2019. And already back then we said, don't bet on a really big turnaround of interest rates. We will see negative real rates for the next years to come. And growing out of the debt problem in real terms is simply impossible. So a sustained turnaround in interest rates, in real rates, is less likely than ever. It is probably more likely that a Dutch skier will win the downhill race in Kitzbühel. But we have seen now that the great moderation might be over, that money supply growth is accelerating, not just base money, but also M2. And this money supply growth is finally manifesting itself in higher inflation numbers, but we are still being told that inflation is transitory. So these trends alone are enough to raise concerns about persistent inflation, but I now want to turn you to some additional factors rooted in policy decisions and trends in the real economy that I see as further inflationary drivers. Fiscal regimes seem to increasingly resemble what our friends at Nordea called Opranomics. The main tenets include a policy that I would describe by going direct. Everyone gets a bailout, helicopter money, MMT-style policies, credit guarantees by the government, universal basic income, and at some point, from my point of view, and I think it's already getting started, we will see a wage price spiral. These kind of radical measures were previously only advocated by left-wing voices. Since the COVID crisis, they are now really mainstream. And politicians, as you know, always calibrate their crisis responses based on the lessons learned during the most recent crisis. So direct transfers are now a permanent crisis instrument and will likely be used every time there is an economic setback. And going forward, CBDCs, central bank digital currencies, will be used to fine-tune the cycle and to avoid, or to try to avoid, every recession via direct transfers. From my point of view, this is an inflationary game changer compared to the decade of standalone quantitative easing policies. QE, as some sort of an asset swap, mostly resulted in asset price inflation. But now with this going direct policy, massive fiscal stimulus, we now really have an inflationary cocktail in place. And the rise of Opranomics is a part of a more fundamental shift that I see happening. This is a shift from monetary to fiscal dominance. It is no coincidence that Janet Yellen became the head of the Treasury. I think the symbolic character cannot be underrated. And from my point of view, the reasons for this is that the toolbox of stimulatory policies available to the Federal Reserve and central banks in general is largely exhausted. Sometimes it seems to me, when I follow markets and market commentators, that everything is about Federal Reserve and central bank policy. So everybody tries to anticipate when tapering will begin, when they will hike rates. This is the only thing that markets seem to care about. But what if central banks are becoming increasingly irrelevant? What if the days of monetary policy being the driving force are actually over? Andy Haldane, the outgoing chief economist of the Bank of England, wrote that for years after the Second World War, the Bank of England was effectively a think tank and that the government set interest rates. We could go back to that. Central bank independence might not formally be cancelled, but the power of central banks seems to be slipping away. And as their power is slipping away, we see new tasks for monetary policy. So safeguarding price stability has always been considered a central objective of an independent central bank. In fact, it is the central mandate of the ECB. But increasingly, one gets the impression that central bankers speak out more often on issues such as sustainability, climate change, or diversity than on monetary policy matters. To me, they often sound like Greenpeace activists or social workers, to be honest. Christine Lagarde, for example, against all customs, she made a public statement of support for the Green Party's top candidate in the upcoming German general election, which is a scandal from my point of view. That's not her job. A further big change is the move to average inflation targeting. In August 2020, Chairman Jerome Powell indicated that the Fed would start adopting this policy. So basically it means as inflation rates were too low, now the Federal Reserve has some leeway for inflation rates to overshoot. And we're seeing the same policy now being introduced by the ECB. And it seems that it works, as you can see on this chart. Since Powell announced that, inflation expectations are on the rise. I now want to briefly touch some inflationary trends in the real economy. Supply chains are being distressed due to high restriction levels and zero COVID policy, particularly in Asia, but also in Australia. We've seen partial close downs of the ports in Ningbo, Suzhou, my Mandarin is a bit rusty, which is the third busiest port worldwide, as well as in Yantian and in Dalian, also top 10 ports, due to the COVID-19 outbreaks just over summer. This has led to a bizarre and remarkable surge in the price of shipping rates. As you can see on this chart, they went basically from 1,200 up to almost 10,000. One of our great clients, he's the owner of a shipping company, and he told us it will take at least 18 months to go back to normal. On top of these policy changes, we're seeing demographic shifts, and we wrote a fantastic chapter, really interesting, about the demographic changes in our last In Gold We Trust report and how they act as an inflationary driver. Of course, we're also geopolitically seeing tensions rising between the US and its allies on the one hand and China and Russia on the other. These tensions could reduce the volume of international trade, resulting in less international division of labor, lower economic efficiency, and rising prices. What you can see on this chart is the last on this picture is the last summit between China and the US. It took place in Alaska. I think there's also quite a lot of symbolism, and the atmosphere, it was said, was extremely chilly, almost hostile. And also the last G7 meeting, it seems that China is now the big enemy. So we are seeing this political trend, which is a consequence, from my point of view, of tensions here as well, that have built over the last couple of years. I don't want to talk about Afghanistan, but definitely the whole region is a powder keg for years, if not decades. Now, let's talk a bit about gold, about miners, and about commodities. Don Cox, he brilliantly said, those who know it best love it least because they have been hurt the worst. And I experienced that at this conference as well. I talked to a friend of mine who, I think he knows gold quite well, and he asked me, where do you see the price of gold? And I said, I can see, or I can imagine all-time highs in the next couple of months. And he said, that's totally impossible. Gold is dead. And I think when real die-hard gold bugs that know gold for so long and appreciate it for so long, if they are already that negative, that's quite telling when it comes to the sentiment. Now, what works in inflation? It is well known that commodities and gold perform well during periods of rising inflation. And this table that we created for the last In Gold report shows that the inflation beta of commodities and of gold is the highest. And long-term commodity price trends indicate that we're due for a price surge. As you can see on the graph behind, showing a 10-year rolling CAGR, well, actually, even though we've seen quite a move recently in the commodity markets, nothing really happened so far. Commodities have been in a brutal bear market for 10 years. This resulted in obviously significant lack of investment activity and declining production volumes. The increase and the higher importance of fiscal stimulus, infrastructure projects, for example, will stimulate the commodity sector much more than it was the case in the pure QE paradigm. Everybody is talking about the new super cycle, but when I talk to institutional investors, nobody is invested in commodities yet. Everybody is seeing it, but nobody is investing in it. Everybody is still heavily underweight commodities. Now turning to gold, ladies and gentlemen, trust comes from repeatedly fulfilling expectations. On this chart, we can see that actually last year, gold was up 25% in US dollar terms. The year before, it was up 18%. In euro terms, last year it was up 14%, and the year before, 21%. Since the beginning of the year in dollar terms, gold is down 3.5%. 3.5% after a 25% surge. From my point of view, that's not that bad. And actually, gold did its job in 2020, like a solid defender of your portfolio. Gold hedges you against risks in equity markets, against rising inflation, and against recessions. Still, I'm not super happy with the performance of gold. But we shouldn't get too greedy, ladies and gentlemen. The job of gold is not to make you rich, but to preserve your purchasing power. If you want to get rich, invest in mining stocks, in Bitcoin, whatever. But the largest opportunity costs at the moment are still soaring equity markets and probably also the attention that the crypto market gets from the media. At some point, this will end. And I see some very interesting developments behind the curtains. Things that show me that the gold market has also experienced a tipping point. Central banks globally are gradually increasing their gold reserves. Russia has quadrupled its gold reserves. We've also seen similar moves in countries such as Thailand, Brazil, and Hungary. Countries that have historically experienced periods of very high inflation. We're seeing increased interest in gold is not just limited to central banks. We also see some moves coming from institutions. I don't know if you saw that, but Palantir, a major data analytics software maker, probably one of the companies that is best connected to government agencies, to intelligence. They announced that they are buying physical gold worth 50 million. By the way, if you don't know what Palantir means, I didn't know it either. It comes from Lord of the Rings. And it means it is a ball of crystal used for communication and to see events past or future. And the CEO of Palantir said, you have to be prepared for a future with more black swan events. I think that was pretty interesting to learn. And the COVID crisis was also the tipping point, perhaps from paper to physical gold. As you can see on this chart, those are COMEX gold deliveries in thousands of ounces. They are going through the roof. Of course, it has slightly stabilized now, but it is still way above the long-term mean. Coming now to the gold mining space. I've had tremendous meetings here already, and I think that the sector is now probably at the best stage that I ever have seen the mining companies. Companies producing record amounts of free cash flow, they pay and increase their dividends, they buy back shares. And remember, ladies and gentlemen, when gold was trading at similar levels of 1,800 in the year 2011, the HUY was trading at 550. Now the gold bucks index is trading at 250, despite the fact that companies are now on a much more solid basis. But the market is not recognizing this value. It's not recognizing it yet. This chart is from my friend Tavi Costa, and it shows free cash flow of the top 50 miners by market cap, and it will probably be even higher this year. So the time is up, but I've still got a couple of charts. I hope you're still with me. So this is a piece of art for every technician. Somebody called it the mother of all cup and handle formations. If we break out above this level, this resistance level, roughly at 2000, the next target, which is a measured move based on technical analysis, would be 2,800 US dollars. And our long-term gold model that we explained or introduced in the In Gold We Trust report last year for the first time, it takes into account money supply growth and gold coverage ratios. It predicts that gold prices by the end of this decade will more than double to a price of 4,800 US dollars. Now that seems outrageous to many people, but actually that's a compound annual growth rate of 13%. It sounds like a lot, but I don't know. If inflation really becomes a concern, I think this is quite realistic. I'm also already coming to the conclusion. In recent decades, ladies and gentlemen, investors, politicians, and central bankers have become accustomed to moderate inflation. But from our point of view, we have now reached a tipping point where inflationary forces are stronger than deflationary forces. Higher inflation rates are not transitory. Central banks will continue to intervene in markets, but their power will increasingly sit in the hands of fiscal authorities. Debts are now so large that interest rates cannot be allowed to rise. The result will be an era of negative real interest rates. And we wrote more than 3,000 pages of research about gold. And if there's just one indicator from my point of view, it is the level of real interest rate that really counts for the price of gold. We continue to see a tremendous amount of value in the mining sector. We predict that 2021 might become the most profitable year of the sector. We expect gold to fulfill its role, its historical role as an inflation hedge, a systemic insurance, and a trustworthy store of value. From my point of view, all-time highs in the next couple of months are clearly possible, and by the end of this decade, we see $4,800. Ladies and gentlemen, like European powers in the build-up to the World War I, I believe we are sleepwalking into a new era from disinflation to inflation. Gold and commodities provide the cleanest, most under-owned, and cheapest insurance policy for the changes that I see coming. Thank you very much for your attention. I hope you enjoyed it, and I look forward to your questions. Thank you very much. The gold price.
This is a question that I have. I don't know if it's answerable, but for about the last several years, the gold price has moved tick for tick inversely to the US dollar. And that seems to be the general consensus of the market, that you need a lower US dollar to have a higher gold price. Problem is, the US dollar is not that strong, and most of the other currencies are not doing that well either. So it's kind of hard to imagine that the US dollar would get much worse than the other currencies. You know, they're all valued relative to each other.
Of course, yeah.
So, and it's not like the early 40s when the US dollar, when people said the dollar was as good as gold, and so it had a long way to fall down. What do you foresee driving the gold price if it's not the US dollar?
I think it's the impact of the US dollar on gold is, from my point of view, overrated. So there's a negative correlation, but I think it's 0.55 between the development of gold and moves in the dollar. But I agree. I mean, of course, a weak dollar would be a good environment for the price of gold, and obviously, and even more for commodity markets. This correlation is much, much more negative. But I just don't see, like colleagues like Brent Johnson, for example, that the dollar will go through the roof. I just don't see it, because nowadays, you know, it's those currency wars, they're happening, and nobody actually wants a strong currency. Do the Europeans want a strong currency? No. Do the Swiss? I mean, that was one of the very few reliable currencies. Do they want a strong currency? No. Does the US really want a strong dollar? I don't think so. So my view is that basically all fiat currencies will continually devalue against something stable like gold, something that is growing by 1.6% every year, because that's the national the average inflation rate of gold. So I don't know. I think Tom Kaplan once said, in a world where fiat currencies are toilet paper, the US dollar is double ply. Perhaps, yeah. I think, of course, it is the most liquid capital markets, definitely. But for example, in the COVID crisis in spring last year, the dollar didn't really go through the roof. We saw a quick move up, a quick spike, and then actually it faded pretty quickly. And everybody would have expected the dollar really going through the roof. So I think this is a sign, and we're I would say structurally we're bearish on the US dollar. Yeah, but that's our view. And technically, I think if we go in the Dixie below 90, then we can go quickly to 30 to 83, 85. So there's basically no real support. It's going to be a tough one.
No, it's not. Great presentation, first of all. Walk us through your rationale behind the 4,800 target for 2030 on gold price.
Well, we actually said what's really important for a currency. And one important driver is monetary growth. So we had a look at average growth of M2 in different historic periods. And then we had a look at the so-called coverage ratio. So basically this so-called shadow gold price. So if you value the amount that a central bank or a country owns, a central bank holdings, valued with current prices, what's the coverage ratio of monetary aggregates? So we calculated that and said, well, perhaps we'll have an extreme scenario like in the 1970s. We can have an average scenario. Basically, we calculated averages since 1971, and then we calculated an average since year 2000. So we calibrated that, and we are explaining it in the 2020 report. And then we made a regression and came up with this price target. So 4,800 US dollars is based on this model. And I worked in a bank for quite a while, and I know that the more complex models are, the less they work in reality. So this is a really, really basic fundamental model from my point of view. And it doesn't necessarily have to mean that it's gonna be 4,800 bucks in 2030. But I think if we really move into this inflationary environment, then we could easily see the trust in fiat currencies kind of dissipating. And I think we are at this stage at the moment. I was in Denver for one day, and I talked to people, and you know, it seems that everybody is feeling inflation. I talked to some business owners, to some restaurant owners, and everybody said, well, we actually can't find any people. We're really paying decent wages, much more than before the COVID crisis. And I read a study by the San Francisco Federal Reserve recently, and they asked, what's really important for the population to anchor inflation rates? So what moves the thinking of people? and it's actually the prices when you go grocery shopping. So if you see in the shops that prices are rising, if you feel at restaurants that prices are rising, your whole mental attitude regarding inflation changes. And I think we are in this process. So from my point of view, this price target is still pretty much realistic. As I've said, a CAGR of 13% isn't that much. But of course, I mean, first of all, we should go to new all-time highs, and then we can talk about 4,800.
I think everybody would agree that cryptos have taken away from gold. How do you see cryptos evolving, especially when you look at it from a generational perspective of, you know, as I always say, boomers love gold, millennials love cryptos. What do you see happening with cryptos going forward from your view?
That's a very important question. And we run two funds where we combine gold and cryptos. So we've got in one fund, for example, 75% physical gold stored in Liechtenstein, 25% Bitcoin stored in cold storage, and we use an options overlay. So actually we appreciate, we harvest the volatility of the Bitcoin space. From my point of view, I think this whole discussion between the crypto camp and the gold camp, I think it's ridiculous. I think, you know, the enemy, if there's an enemy, or what you want to hedge against is fiat currencies. And from my point of view, it's no coincidence that the stock-to-flow ratio, for example, of gold is very similar to the stock-to-flow ratio of Bitcoin. It is no coincidence that the logo of Bitcoin is actually a gold coin, that you're mining Bitcoin. So I think there are many similarities, and once in an interview, I was asked, you know, gold or Bitcoin, and I said, why not both? You can have in your portfolio, you can have a stable, big Volvo SUV, great car for your family. And you can also have a motorcycle like a Ducati Panigale. You can have both, and you can get from A to B with both. Of course, in the Volvo, it's gonna be safe, and you're gonna have a smooth ride. And with the motorcycle, you know, as soon as it starts raining or snowing or whatever, it's gonna get more risky, but it's also fun. So from my point of view, I think both fits into one portfolio. I think it makes sense to actually combine it. And therefore, I think that the gold industry also should not, they should appreciate that there's competition coming up. And I think competition is something great. It makes products better. It is essential for our system. So I think we should try how to combine both assets. And actually for young people, they want something digital. They don't want to have physical gold bars. They want to do everything on their smartphone. So I think it is really important to make gold and mining stocks more appealing to the younger generation, but also for the crypto space to become more appealing for the boomers generation.
When you think about, thank you, tipping points, and I know you're thinking that we could go to new highs a lot sooner than most people think. What are some of the things that you think could drive it? Could it be just a CPI report that's unpalatable, or Powell being made to look like a fool with his transitory dialogue? But all the robo traders, the algos, are geared to trade gold inversely with the dollar. And I agree with you, it's overrated. But when we see smash downs like we saw in August and again at the beginning of September or after Labor Day, I think that's what's going on. You have the sort of mentality of these macro thinkers that rates are going to go up, and that therefore the way to position for that is to be short gold. So I'm just wondering, I think about it a lot, what do you think would be some of the things that could reverse that thought process?
Of course, that's a question talk that I think about quite a lot. And I don't understand gold at the moment, I have to say. I don't understand women sometimes, and I've got 4 girls at home. But I think on a longer term, the market is kind of rational. And I think people will realize that gold is a pretty good inflation hedge. But I think the market now really believes, or the algos, hedge funds, whatever, I think they really believe that it's transitory. Absolutely. And it is my view that it's not transitory. So I'm definitely not having a majority view on that. I think market-wise, I think it would be good to actually have some sort of a decision when it comes to tapering. This whole when will it start? Is it gonna be in October or later on, or does Jay Powell want to become renominated? I think it would be good that actually there's a date, and we're currently crunching the numbers. We're doing a publication where we analyze how gold reacted in different tapering environments. But my gut feeling is that actually, similar like with rate hikes, we saw it previously, that actually when we then saw the first rate hike, gold took off. And I could see something similar. And then, of course, the big question is when the party in the equity markets is going to stop. I mean, we all know that those valuations are crazy. We all know that the party is going on for quite a while, but I mean, I don't go to parties too much anymore, but we know that those parties, if they really get crazy, they can go much longer, and especially if there are illegal substances involved. And, you know, the markets, obviously, they are, you know, there's lots of illegal substances that is pushing this party. So long story short, I would say some sort of a decision on the tapering. I think the market realizing that inflation is not transitory. And then I think equity markets kind of rolling over. That would be a thing that should actually put momentum in the price of gold. So if there's no other question, thank you very much. And now the fun part starts. So we've got the reception at the patio. Thank you very much. Thanks.